Bismillahir Rahmanir Rahim. So today we are going to discuss the national income accounting. Before delving into the presentation of this topic, I want to make an announcement. If you come across any question or if you need any further clarification of the ideas in this presentation, please use the chat room in the LMS system or either reach out to me through the WhatsApp group that has been created, and I would be available to answer your questions or give further clarification of the ideas. Now, national income accounting is a very important subject in the context of macroeconomics or in the context of the overall economy. It is important for several reasons. Number one, national income accounting guides the economic policies or inform the economic policies of the government. It also help the government to prepare sound economic planning. Traditionally, it has been used for comparing the living standards of people across the time or between the countries. So, national income accounting measures the economic performance of an economy. There are different concepts under the umbrella of national income accounting, and we will be discussing every concept in details. For example, GDP, gross domestic product, gross national product, net national product, personal income, personal disposable income, GDP deflator, and real GDP. Now, as I said, national income accounting measures the economy's overall performance. For example, it talks about the performance of the economic growth in any particular area compared to any base year. It can also talk about the investment, the savings, and even the distribution of income in the country. The very basic component of national income accounting is GDP. Gross domestic product is the value of all final goods and services produced within a country in a given period. The components of GDP is the consumption by households, investment by firms and households, government expenditure, excluding transfer payment. We will discuss this. And then there is the net export, the difference between export and import in any particular area, in any particular year. Now, as we discussed this in the previous slide, why denotes GDP or gross domestic product, and it is the combination of consumption, investment, government spending or expenditure, and the net exports. Things that are not part of the GDP: intermediate goods, secondary hand sales or used goods, the black market, the black economy or the underground production, and the financial transaction. Intermediate goods, we do not include them in the GDP, in the calculation of GDP, because if we include them, that would lead to the double counting, something that would inflate or over-report the GDP, or over-report the over represent the economic performance of an economy. And for that particular reason, we are excluding this from the calculation of GDP. Second hand sales, why we do not include it? Because it has already been included in an year. Black market economy, because it is not formal, it is not formally registered, so no country consider this in the calculation of GDP. In financial transaction is the buying or selling of the government securities, for example, of the bonds, stocks. Why? Because it does not add any value to the economy. Approaches of GDP, we can measure the GDP of any particular country in three ways. Number one is the expenditure approach. We just discussed this. Consumption plus investment plus government spending plus net export, or the difference between export and import. Second, income approach. Income approach is the combination of wages that comes from labor, interest rate, capital, plus rent that comes from the land, plus profit, that is the entrepreneurship. Now that is GDP. Now if we deduct net factor income, or the income that comes from the non-resident minus the income that goes to the non-resident, that would amount to GNP, gross national product. We will discuss the peculiar distinction between GDP and GNP in the next slides. Furthermore, if we deduct the depreciation from GNP, that would amount to net national income. The third approach is the production approach, which is the gross value of output minus the value of intermediate consumption. Actually, it comes from the different sectors. For example, the production comes from the agriculture sector, from the industrial sector, from the service sector, from the tourism sector, from different sectors that comes. So GNP We discussed the concept of GDP, and we use the concept of GDP within the geographical boundaries of any particular country. On the contrary, GNP does not consider or does not take into account the geographical location. As long as the production is owned by a country's residents, no matter where it has been produced, is part of the GNP. For example, GNP is equal to GDP plus factor payments from non-residents. The payments that are coming from abroad in different forms, minus the payments that are leaving the country in different forms. That is GNP. Both GDP and GNP are being used in different contexts. Now, net national product is equal to GNP minus depreciation. So depreciation is the decrease in the economic value of the capital stock, and that depreciation may have been caused either by physical depreciation or change in the demand for the services of the capital in question. Personal income is the income received by households after paying social insurance taxes but before paying personal income taxes. Personal disposable income is the amount of personal income minus taxes, minus personal income taxes, like PDI is equal to personal income minus taxes. Discretionary income equals personal disposable income minus all payments. Now, as we discuss the GDP, one of the very important topic in economics and widely used in the discourse of the economy is the distinction between real GDP and nominal GDP. In order to capture, to gauge the performance of the economy in a real sense, in a real way, we need a real GDP. Because if we rely only on nominal GDP, that could be misleading. Our assessment, our analysis of the economy could be misleading sometimes. Because real positive change or improvement in the economy can occur only through the increase in production. On the other hand, nominal GDP can increase either by the increase in production, by the increase in prices, or even, for example, if any calamity, if any catastrophe happens. that uh, may lead to the increase in nominal GDP. But we can't say that uh, there is an improvement in the economic activity. And for that very reason, we need to separate nominal GDP from real GDP. For example, in the nominal GDP, the market value of final goods and services evaluated at current year prices. And this is the distinction between nominal GDP and real GDP. In the real GDP, the market value of final goods and services evaluated at base year prices. We will discuss the the idea of current year prices and base year prices. Here to summarize, nominal GDP can change over time due to changes in either price or output Q. But change in real GDP can only happen if there is a change in the output in Q. So we do not consider the change in prices in real GDP. We only consider change in quantity, change in output. Simple rule is real GDP equals the base year prices multiplied by the current year quantities. We will further elaborate this in an example. For example, uh, this is a typical example. Production in price statistics for any economy in 2009. There are different commodities: sunglasses, suntan lotion, and simmers. Quantity is given and the price per unit is given. If you want to find the nominal GDP, we simply multiply quantity by price and then add them up at the end, and that give us the nominal GDP. But for 2010, we can do the same. But if you want to find the real GDP in 2010, what we do is that we multiply the quantity of 2010 by the prices of 2009, which is the base year for 2010, and that will give us the real GDP in 2010. Rate of growth of real GDP. There are different formulas, but the most conventional one is real GDP in the current year minus real GDP in the previous year divided by real GDP in the previous year multiplied by 100. Example is given below. In 2005, real GDP was 1248 billion. In 2006, real GDP was 1282 billion. And to find the real GDP in 2006, we use the formula, and that is 2.7%.